Next question comes from PT in Utah. Why do we care about EBITDA?
Good question.
I know what it stands for. I know what it means, but I must not know what it means because I always think, why not tell me EBITDA, earnings after? Oh my goodness. Now we got a lot.
We'll
EBITDA is like GBBPCIS, grades before beer parties and calling in sick.
Oh boy. All right. For the rest of the audience, let's define EBITDA. Earnings before interest, taxes, depreciation, and amortization. And what it is it's a quick and dirty method of estimating operating cash flow. All over Wall Street, investment bankers all over the world right now are talking about EBITDA because it's just a really quick way to think about cash flow. Now, I say operating cash flow rather than total cash flow or free cash flow because this just focuses on the operating business. It removes interest because it's before interest. Interest is not an operating decision of management. It's a financing capital decision of management. It's different than do you make a good product and do you sell it for a fair price and make a profit. So if we want to just look at the operating business, let's remove the effect of interest. We also take out taxes because there's a lot of decisions that affect taxes that everybody has to pay them by law. But if we really just want to focus on do you sell your product, do you make a profit, let's just remove taxes for analysis purposes. And finally, the bigger deal here is we want to remove the impact of depreciation and amortization, which are non-cash expenses. When you buy a big manufacturing facility for $500 million, GAAP accounting lets you divide that amount by 15 or 20 years and deduct from your income that 1/15th as an expense, which lowers your profits, which lowers the taxes you have to pay. So it's a tax benefit. But it's non-cash. You didn't really have that expense. So we adjust for it to get an idea of the actual cash flow a company has. If you owned 100% of that company yourself, how much actual cash could you put in your pocket at the end of each year? That's different than GAAP net income. It's not the same thing. So we make adjustments here to look at operating cash flow to get a better understanding of how this business is performing and how much cash they're actually producing.
And you're fine with EBITDA.
I'm a big fan.
Big fan.